There's a growing divergence in the manufacturing industry, shown here specifically between the New York and Philadelphia regions. Our goal here is to identify exactly why this is happening and how we might be able to take advantage of it. Earlier this week, it was reported the Empire State Manufacturing Index falls to negative 12.6 in January. Empire State Manufacturing Index reflects that manufacturing industry in the New York State. And we can see here, negative 12.6. It's a lowest low we've seen going back to July of this past year. Manufacturing, to say the least, has been on shaky ground for quite a long time. This week's development is not a good turn of events. Now, break down the Empire Manufacturing Index into its subcomponents. We've spoken about this dynamic before. Prices paid is much higher than prices received. Prices paid is what the wholesalers have to pay for raw materials. Prices received is what they're able to charge for the finished goods. Now we can see here in blue, prices paid, in red, prices received. The divergence really has not been higher, at least over the past couple of years, and this is not good. This shows us that the profit margins are being squeezed. If this sounds familiar, it should. We spoke about this dynamic earlier this week, but in the inflation data, wholesale prices reflected by PPI are up a lot. Consumer prices reflected by the CPI are up, but up less. And as a result, the profit margins are being squeezed. The producer just can't charge as much as they would like in order to cover the costs of the rising raw materials. Now, this is CPI minus PPI on a year-over-year basis, and we can see, we spoke about this earlier this week, third consecutive month in negative territory. What does that mean? On a year-over-year basis, consumer price index is rising slower than the producer price index. Raw material prices are rising faster. Now, on the other hand, we have a Philly Fed's index. That factory gauge surged to the most since June of 2020. Really amazing number, actually, hitting a level of 44. When was the last time we saw 44? Well, we have to go all the way back to 2020, 2021. So this certainly is a positive turn of events, and this represents the manufacturing industry in the Philadelphia region. Breaking down the Philly Fed, we can see the prices paid, prices received, very close together. And this is what we want to see. We want to see the manufacturer has the ability to charge enough to cover the costs or the rising costs of the raw materials. This is better for their profit margins, also better for jobs too. Here in blue, prices paid. Here in red, prices received. And we can see that this contraction really kind of accelerated this past month. This month's report was a really positive turn of events. Now, taking a look at in red, Philly Fed, in blue, Empire State, and notice the divergence between the two. The Philly Fed, going back to February of last year, just about a year's time, has really improved quite a bit. The Empire State Manufacturing has not. There really is a growing divergence between the two. Now let's compare with the subcomponents, maybe where this is happening exactly. Take a look at number of work hours. On Philly Fed side, positive 20. Empire Manufacturing, negative 15. See, when the profit margins are being squeezed, that affects everything, including and especially employment. We take a look at general activity. Those are the big numbers. 44 positive on the Philly Fed, negative almost 13 on the Empire Manufacturing Index. We take a look at new orders for new business. 43 in Philly Fed, negative 9 in Empire Manufacturing. We can also take a look at shipments. Philly Fed, positive 41. Empire Manufacturing, negative 2. So there certainly is a stark divergence between the two. Now, let's consider all this in terms of our own investments, in terms of the stocks that are going to report earnings, coming up in the next couple of weeks. How can we take advantage of this? We have to identify the differences between the two. Now, New York specializes, the New York Region Manufacturing Index specializes in high-tech sectors, aerospace, pharmaceuticals, electronics. They also focus a lot on domestic production, so to speak. and workforce development programs for in automation, robotics. It really seems a high-tech area is centered in the New York manufacturing industry versus the Philly Fed, which has a rich history in textiles, food processing, things of that nature, more, I would say, durable goods, domestic type of production. Sustainability and green manufacturing is also centered in the Philadelphia manufacturing region, as well as infrastructure, logistics, things of that nature. So think of the differences between the two and see if they align with any investments that you may have that focus on the manufacturing industry. Just a reminder, if you haven't already, please visit our Jobs Data Substack newsletter, where we post not only long form articles, but also notes, observations about the markets, and also ideas that we're working on that we'd love to hear your input about as well. We hope this has been helpful. We look forward to seeing you back soon.